You're very welcome to this free tutorial with Navigator.com, and today we're going to show you how to build a high dividend yield portfolio in the stock market. This is the first of a two-part series of videos. So today we're going to show you how to construct a portfolio, and then on the next video we're going to show you how to generate a monthly revenue stream by selling covered call options on each of your stocks in it. Okay, so what are the driving principles behind the high dividend yield strategy? Well, the first starting point, you need to find good quality companies. That's an absolute must. Secondly, the companies must have a track record of paying sustainable high dividends. Okay, so you don't want companies that have announced all of a sudden that they're paying a dividend today, and it might be a big dividend, but if they're not going to pay it next year and the year after and the year after, that type of a company would not qualify for this strategy. And the whole objective really is to build a portfolio that gives you a steady stream of income over a number of years. And it's a very good alternative, this strategy, to investing into the bond markets or into the treasury bills, etc. like that. So what are the company characteristics? What are the typical characteristics of a company that would fit into this system? Well, really they're older, more established companies. They're large market capitalization. What does that mean? They're basically the biggest stocks in the stock exchange. They're the behemoths, the Microsofts, all those type of companies. But they're no longer able to sustain high levels of growth to warrant higher share prices. So large cap companies often fall into this situation. When they were very small, it was easier to grow at double-digit rate in their earnings. But as they get bigger and bigger and bigger, it gets much more difficult to do. And finally, the respective industries are no longer rapidly expanding. So typically that's another characteristic that they'd be involved in this industry that isn't growing at a rapid pace either. So rather than the company reinvesting its retained earnings to grow the share price, they reward the shareholders by way of paying a dividend on an annual basis. Okay, so that's what you're looking at. That's the typical profile. Just one thing here, very, very, very important. An awful lot of retail investors make this mistake. It's not the dividend amount that counts, it's the dividend yield. So the dividend yield is the most important thing you need to look for. How do you calculate that? It's very simple. It's the annual dividend per share divided by the current share price. So for example, if a company is trading at $100 and it pays an annual dividend of $6 per share, it has a dividend yield of 6%. So it's the dividend yield that's important. And just to be aware, the S&P 500, the average for the benchmark is 2 to 3% on the dividend yield. Lately it's actually been slightly below that. Okay? So just a couple of things you need to be wary of when you're choosing high dividend stocks. Make sure the company has a track record over the last 5, 10, even 50 years of paying a dividend. For example, Ryanair recently announced a large dividend for its shareholders. That doesn't count, folks. It has to be something that they're going to pay year on year for the next 5, 10 years. That's the type of company you're looking for. So you're not looking for a company that all of a sudden pays out a large dividend, all right? So what stock markets can this strategy be applied to? Any stock market. European stock markets, US stock markets, Australian stock markets. It's totally up to yourself. But just for the purposes of this session, we're going to focus on the US stock markets and focus on a strategy that's very famously known as the dogs of the Dow Jones. Okay. So what is it? The Dow Jones Index, folks, for those of you that don't know, just represents 30 of the largest cap companies floated on the New York Stock Exchange. So that's what the Dow Jones represents. When you hear in the news that the Dow was up 1% today, all that means, on average, among 30 companies, they were up by 1%. All you do in this strategy, you select the 10 stocks which have the highest dividend yield. That's all you do. So let's go through a step-by-step process. At the end of every year, you assess the 30 components of the Dow Jones and you assess which 10 have the highest dividend yield. You invest equally to each of the 10 stocks. Then you come along the following year, you reassess the Dow Jones 30 again. If your current stocks, the 10 that you've invested into, no longer are the highest dividend yield payers, you replace the ones that fall off the list with the next high dividend yield. and you just repeat the process over a number of years. Please note, this is a longer term strategy. It's not for traders. This is for people who are investors who are happy to see kind of an annual income coming in. For those traders who want to buy and sell it quickly, this isn't the type of strategy for them. Although part 2 video will actually show you how to generate additional revenue, which may satisfy the needs of a trader. So what has the historic performance been like? The bottom line, over the last 60 years, folks, it's outperformed the benchmark indexes by an average of 3% on an annual basis. That's pretty substantial. Does that mean it's going to continue to do that? Absolutely not. But you do look at history to give you an idea of what some of the best strategies are. How are we performing year to date? Well, the S&P 500 at the time of me doing this presentation is down around 6%. The dogs of the Dow are only down 1.5%. So this year it's actually outperforming the benchmark by 4.5%. All right, and you still have a dividend yield to add in here, which hasn't been accounted for, of about 4.5%. Okay. Here's my high dividend yield portfolio. I constructed it on the 8th of June of this year. Here's the 10 stocks I chose, all the way down here. And you will see, you know, there's a number of stocks there, the share prices, this is the dividend amount, the dividend yield, which is the important part. The ex-dividend date, that's very important, folks. This is the date that you must own the shares by if you want to be applicable for the dividend by the company. The amount of shares I invested, the dollar amount investment, and my weighting in each stock. So as you can see, I wasn't exactly equally invested, and part 2 I'll show you why I wasn't. But my returns are pretty good. I'm very happy with the portfolio. Currently it's up 2.63% since the 8th of June. It started off very well. It was actually up at 5% at one stage. I have an annual dividend to look forward to of 4.7%. Now when I compare that against the S&P, it's only returned 0.25% in the same period of time. So our portfolio is outperforming the S&P 500 by 2.36%. So we're doing very well, and we still haven't factored in the fact that we have a dividend yield of a number of the stocks to get as well. So just be careful. Just because the strategy worked in the past, it's no right or guarantee that it will work in the future. So just be aware of that as well when you're building your portfolio. I can already hear an awful lot of you saying, I don't have 100,000 to invest in the stock market. I can't invest into this strategy. Well, you don't have to, because there's a number of exchange traded funds that you can invest into that are high dividend yield paying as well. So SDY is an example of one. It represents 98 stocks. The current price of that is $46.35, and the dividend yield is 3.8%. DVY is another one, and it's pretty similar as well. So you can invest into those stocks and get the benefits of a high dividend yield strategy. In the next video, we're going to teach you how to generate an ongoing monthly revenue stream from these stocks by selling covered call options. So I do hope you join us. If you would like to get more information from us, we hold free stock market seminars. Just go to our website, stock market, www.sharenavigator.com, and register for a free online webinar. So you can register from anywhere in the world, and we'd be delighted to help you. Okay, thanks and bye for now.